My name is Kelly McManus, and I've been proud to serve as the chair of the board of directors of the Greater Kitchener-Waterloo Chamber of Commerce since our AGM last September. And I'm quite sure that at the time, no one would have foreshadowed the world we've been experiencing since March. And this annual general meeting is one for the history books as we host our first ever Zoom annual general meeting. Thank you all for being here. As we begin, I'd like to take a moment to acknowledge that we live and work on the traditional territory of the neutral, Anishinaabe, and Haudenosaunee people, as we seek a renewed relationship based on the foundation of mutual understanding and respect. I'd also like to recognize a number of municipal colleagues who are here with us at our virtual AGM this morning. A warm welcome to Regional Chair Karen Redmond, City of Waterloo Mayor Dave Jaworski, City of Kitchener Mayor Barry Verbanovic, Township of Woolwich Mayor Sandy Shantz, and Region of Waterloo Councillors Jim Erb and Elizabeth Clark. I'd also like to thank today's sponsors, Cowan Insurance Group, EY, Home Hardware Stores Limited, MCAP, Wilfrid Laurier University, University of Waterloo, and our speaker sponsor this morning, TD Bank Group. Today's AGM will begin with the formal business meeting, followed by a presentation from our speaker, Derek Burleton, Vice President and Deputy Chief Economist with TD. There'll be a short Q&A session following Derek's presentation, and we will finish with a networking opportunity in smaller breakout rooms to conclude today's event. I do encourage you to stay through to the end of our sessions. And I don't want to make any assumptions, but I think we're all getting the hang of these virtual events. But I still need to remind you to please ensure your microphones are muted throughout the presentation so we can reduce any background noise. If you have any questions that come up throughout the meeting, you can type them into the chat box and in the control panel at any time. You can access that area by clicking chat at the bottom of your screen. If you are a voting member for this morning's meeting, we ask that you please participate in the voting poll that will pop up on your screen at the appropriate time during the meeting. The poll will stay open just for a few seconds in order to keep the meeting moving swiftly. So please, please be on the ball and be ready to vote as the motions are intended to move quickly. If you're unsure whether you have voting privileges, now is the time to use the chat function to confirm that with Chamber staff. A reminder that this morning you will have received in your event invitation a copy of our electronic annual report. And if you enjoy yourself this morning at the AGM, the annual report just keeps on giving all year long. I would now like to call our 2019-20 annual general meeting to order. Notice to members has been properly given, and with quorum met, the meeting is properly constituted to conduct business. I call for a motion for approval of the 2019 annual general meeting minutes.
I would move that the minutes of the annual general meeting held September 24th, 2019 be adopted as circulated.
I second the motion.
Any discussion? Passed. Thank you. Great. As your chair, I have a few moments to reflect on our past year, and I promise not to use the words unprecedented or new normal. But I do want to take us back in time a little before COVID, if we can recall those days. And one of my favorite chamber experiences, and perhaps yours, is the Business Excellence Awards and Gala. So picture us back at Bingaman's. I miss Bingaman's, don't you? We were there on February 20th, and hundreds of us were dressed up, celebrating all of the achievements of business and leadership in our community. And of course, less than a month later, our world changed. As chair, I was proud to watch that your Greater KW Chamber of Commerce was here, as you need us to be, exactly in times like these. Our staff and board immediately rose to adapt, to advocate, and to collaborate in true Waterloo Region fashion. Those daily briefings in your inbox, we were keeping our members in the know under rapidly changing circumstances. Early pivots to online networking and education events kept our members connected and linked to top resources and experts. We mobilized swiftly with the Waterloo Economic Development Corporation, Communitech, and the Cambridge Chamber of Commerce to strike the Business and Economic Support Team, or BEST, Waterloo Region. BEST ensured strong and collaborative advocacy to the Prime Minister and our Premier as we represented the collective voice of our regional economy on policy matters that will keep our local economy strong and protected. And alongside our colleagues at the Ontario and Canadian Chambers of Commerce, we advocated tirelessly on behalf of our members. We were vocal about the need for timely and appropriate emergency responses, such as the Canada Emergency Response Benefit, and for wage and rent subsidies that kept doors open as best as possible. Of course, as phased-in strategies came to reopen business over the summer, we were there to advocate for tools and supports like mandatory mask bylaws that worked for the greater good of our businesses and our community. And of course, as we watched the arrival of a second wave of COVID and the lengthy economic and social fallout that undoubtedly looms, there's a great deal of uncertainty that still lies ahead. I can assure you that our chamber will continue to be a watchful advocate and leader in the months and years ahead. As you all know, within your own organizations, leadership is tested under these circumstances. Thank you to our President and CEO, Ian McLean. Working alongside Art Sinclair in advocacy, Ian kept our voice heard and our relationships strong. Working with Lester Hawley, you kept our organization moving forward, and spoiler alert for our audited statements, on pretty steady financial ground. A thank you as well to the rest of the chamber staff team who were responsive to our members and have kept our events timely and relevant, including our Canada's Innovation Corridor Summit happening a week from today. And yes, that's a shameless plug to get your tickets now if you already haven't. A thank you finally to my board colleagues. Before the world changed before our very eyes, we did some outstanding work together to build a new strategic plan. And while we may not have predicted a global pandemic, I think our plans to be more nimble and more digital were spot on. Thank you, colleagues, for your commitment, for extra meetings and extra attention to the work of the chamber during the pandemic, as you also managed change in your own organizations. Serving as board chair this year is certainly something I will not forget. I'd now like to introduce our Finance Committee Chair, Patrick Clan, to present this year's financial report.
Thank you, Kelly. I've been delivering the financial portion of this AGM for a few years now, but as Kelly said, none really compares to this year. To say it's been a challenging year would be an understatement for the chamber, its members, and maybe everyone joining us today. I've been asked to present the audited financial statements, but before I do, a few notes. A thank you to Murray Short and his team at RLB for providing this year's audit. I'm happy to relay their findings of a clean audit. That is, the financial statements present fairly the results of last year and where we stood at June 30th. In line with this, compliments and thanks to Lester and his team at the chamber for keeping the books and records easy to audit and free from anything significant that needed adjusting. We were all given a copy of the financial statements ahead of time, so if you care to join me, I'll point out a few highlights and I'll do my best to be brief. First, on the balance sheet on page 4, you can see we have a positive cash balance, although lower than last year, largely the result of the pandemic and the event postponement that we saw in the last 3 months of the year. The chamber does still have cash on hand and available borrowing capacity, to date not yet dipped into. The other main assets are the government wage subsidy receivable, that's the CEWS, as well as the building and the intangible asset for Shop KW. The largest liabilities, or the obligations of the chamber, consist mainly of membership fees paid in advance for months to come, as well as sponsorship for events falling after June 30th. We see the new government CEBA loan, as well as the Shop KW remaining loan balance. Overall, the results of the year, which we'll see on the next page, have left the Chamber in a deficit position, but there's a plan in place to reverse this shortfall in the years to come. Turning briefly to the next page, we see the results for the year. As in years past, the majority of the Chamber's revenues come from membership fees from everyone joining us today in the form of membership fees, as I said, and also event attendance and event sponsorship. The two largest expenditures are, of course, the cost to put on those events and the salaries for the people that make it happen. As I mentioned on the last page, the Chamber is expected to benefit from the government's CEWS wage subsidy, and we show that on the third line. A few unique items as other this year. The Chamber had a portion of its Shop KW liability forgiven and also benefited from the forgiveness of the government loan. And finally, we see an impairment that is the intangible asset written down to an expected fair value. Overall, the COVID pandemic has shown just how quickly things can turn upside down. The move to digital and the continued support of members and sponsors have prevented what could have otherwise been a devastating year. The combined work of the Chamber staff and the board has meant that the Chamber was able to weather the COVID storm thus far and end the year at a manageable deficit level.
Thank you, Pat, for the report. And I call for a motion to approve the financial statements.
Yes, on the recommendation of the Board of Directors, I move that the financial statements for the year ended June 30th, 2020, as audited by the firm RLB LLP, be approved.
Second the motion.
Sorry, thank you. Thank you, Brad. Any discussion? You'll see the vote on the screen in front of you. Call the vote. The motion is passed. Thank you. I'd like to call for a motion to appoint the auditors for the 2020-2021 fiscal year.
The Board of Directors recommends that the firm of RLB LLP be appointed auditors for the Greater KW Chamber of Commerce for the 2020-2021 fiscal year.
And I would second that motion.
Any discussion? Call the vote. The motion is passed. I'd like to call for a motion for ratification of chamber business.
I would move that resolutions, minutes, contracts, appointments, and payments, acts, and proceedings of the Board of Directors and officials of the Greater Kitchener-Waterloo Chamber of Commerce up to the present time by hereby ratified and approved, and said directors and officials released from all liability herewithin.
I second the motion.
Any discussion? Call the vote. Motion is passed. Thank you. I'd like to call for a report from the chair of the nominating committee, our past chair, Renata Rosiniak.
The chamber bylaws provide that the chamber be managed by a board consisting of not less than 11 and not more than 22 directors. A nominating committee appointed by the board recommended 3 candidates for the available positions on the board. The call for independent nominations for the 2020-2021 Board of Directors closed on June 26, 2020, with no additional nominees. As such, an election is not required. Scott Gilfillan, as the board secretary, can you confirm that in accordance with our bylaws, a slate of candidates was sent by the nominating committee and notice sent to chamber voting delegates representing our member firms in good standing that an election is not required?
I so confirm.
Thank you. The slate of nominees includes Nick Hefner, Hefner Lexus Toyota, Shelley Forwell, Walter Fady, excuse me, and Carleen Carroll, Wilfrid Laurier University. Please participate in the Zoom poll to confirm the nominating committee's slate of names to the 2020-2021 Board of Directors. Thanks, everyone. The motion has passed. I would like to now call for a motion for appointment of Allison Burke, Waterloo Oxford Learning, Adam Smith, My IT Guy Corporation, and Glenn Thorpe, FlightPath, for an additional 2-year term. These individuals are currently at the end of their 2-year term and will be appointed for another 2-year term.
I would move that Allison Bork, Adam Smith, and Glenn Thorpe be appointed for a 2-year term commencing the 2020 to 2021 fiscal year.
I will second that motion.
Thanks, Sean and Chris. I would ask that you participate in the Zoom poll to confirm the reappointments as stated. Any discussion? All right, it looks like the motion has passed. Carried. Thank you very much. I am pleased to announce that the following individuals form the 2020-2021 Board of Directors for the Greater Kitchener-Waterloo Chamber of Commerce. Adam Smith, My IT Guys, Allison Burke, Oxford Learning Center, Andrea Burbanek, Exonify, Brad Dunbar, Goetz Dunbar Professional Corporation, Carleen Carroll, Wilfrid Laurier University, Glenn Thorpe, FlightPath, Kelly McManus, University of Waterloo, Chris Ronan, Ronan Consulting, Nick Hefner, Hefner Lexus Toyota, Richard Jocks, BMO Financial Group, Scott Gilfillan, PwC, Sean Sullivan, Gowlings WLG, Shelley Forwell, Walter Fady, and Wendy Campbell, the Food Bank of Waterloo Region. I can hear the applause from here. I would now like to introduce the city of Kitchener's Mayor, Barry Burvanovic, to perform the official induction of the board. Barry?
Thanks a lot, Renata. And just before I do that, I just want to take a few quick seconds to thank you, to thank Kelly and the board, as well as Ian and the team, Ian in particular for his work on Best Waterloo Region, for all of your collective efforts on behalf of our business community over the past 6 months. Today is actually the 6-month anniversary since we declared an emergency. And I know all of you have been going above and beyond. And the fact that you're all willing to continue to do that and take on these responsibilities on behalf of our local business community is much appreciated, I know, by all of the elected leadership in the region. So thank you. So if I can, I will read out the oath, and I'll ask everyone to, at the end of me doing that, to simply say I do. So if you can turn your microphones on in that regard. It asks that you stand, but I'm not sure that you necessarily need to do that where you are. And so the oath is as follows. I swear that I will faithfully and truly perform my duties as a board member of the Greater Kitchener-Waterloo Chamber of Commerce, that I will, in all matters connected with the discharge of such duty, do all things as I shall truly and conscientiously believe to be adapted to promote the object for which the said chamber was constituted according to the true intent and meaning of the same. So help me God.
I do.
I do.
Thank you.
Thank you very much, Mayor Burvanovic. And also, thank you for not making us stand. I may or may not be wearing yoga pants. I would like to take a moment to thank the Chamber's corporate partners for their support over the past year. These partners are also listed in the Chamber's annual report, and you'll see them on the slides here. I'll quickly run through them, and a big thanks, of course, to all. Our Chamber Chairs Circle, BDO, BlackBerry, BMO, Cowan Insurance Group, Enbridge, the Equitable Life of Canada, EY, GHD, Gowling WLG, LLP, Hefner Lexus and Hefner Toyota, Home Hardware, Manulife, MCAP, McCarter Gruspin, MNP, SG Cunningham Limited, Sun Life, University of Waterloo, and Wilfrid Laurier University. Our Chamber patron sponsors, BDC, Cushman and Wakefield, Waterloo Region, Meridian, PwC, and Raffi Jewelers. Our title sponsors, Cowan Insurance Group for the 12 at 12 luncheon series, Hefner Women's Leadership, Libro Credit Union, Chamber for the Chamber Young Professionals, Manulife Chamber Academy, J Fencing, Business Around 5, and MNP Networking Breakfast Series. Our Chamber trustees, Bell, Conestoga Meatpackers, MTE, Walter Fady, and Waterloo EDC. Our media partners, 570 News, 96.7 Chime FM, Country 106.7, CTV, Snapped KW, and the Waterloo Region Record. Finally, thank you to all of our physician recruitment sponsors for the continued support of the Chamber's healthcare initiatives. These sponsors are crucial to the success of the Chamber Healthcare Resource Council's annual Family Medicine Resident Weekend, going into its 18th year. This event is instrumental in residents' decision to establish their family practices in the region. And of course, this initiative is more needed than ever. A few moments to thank our volunteers when we acknowledge our outgoing committee chairs and retiring directors. This is always a bittersweet part of our AGM, given how vital volunteers are to the work of our chamber. Thank you to those volunteers who are listed on the screen. I do want to take a moment to recognize our retiring committee chairs, and of course, they're welcome to volunteer in the future. Thank you to Susan Cranston from the Women's Leadership Committee, Dawn Wales from the Chamber Golf Scramble Committee, and Diane Horolenko from the Federal and Provincial Affairs Committee. Susan, Dawn, Diane, this is normally where you would get a standing ovation for all your hard work, so please picture that happening in the background. I would also like to acknowledge our retiring directors. And we knew this year we would be losing a significant number of longstanding members and a lot of talent. And that's certainly the case as I will share with you now. Rainey Gatien from Waterloo North Hydro, you shared a depth and wealth of experience with us on the board, particularly around matters of leadership and governance. I like to think that you've earned your legacy when you get a nickname from your fellow board members, and we call you the Wise Owl for those reasons. Thank you, Rainey. We will miss your expertise. Mark Christensen, you chose your words very sparingly in the 6-year run on the board, but you saved them for when it really mattered. That's a gift. And you also happen to rock a mean bow tie. Thank you, Mark, for your contributions. Patrick Clan, our Finance Committee Chair and Fiscal Rock, has presented finance statements like no other. I think you're the first person who's actually made them interesting, if not some months entertaining. Thank you, Patrick, for your leadership. Renata, our past chair, who joined the board as I did 6 years ago, which feels like yesterday. Renata is a stickler for process, and she has a fantastic memory. She enjoyed the chair role so much that she actually did it for 2 years. So Renata, thank you. Personally, it was an honor to follow in your footsteps, and I appreciated all of your support this past year. And finally, Jeff McIntyre, who we could always count on for a laugh, for saying the things that everyone else was thinking, or just the look on his face. Jeff is wrapping up his 6-year term, but his commitment to the chamber through the board and various committees, I understand, dates back to 2004. Jeff Mack, thank you. We will now play a video compilation of all of your highlights from the board. Just kidding. We will now hold a short meeting of the Board of Directors to appoint the Executive Committee for 2020-2021. I'd like to call the board meeting to order. In accordance with our bylaws, the Board of Directors recommends the appointment of the members of the Executive Committee for a one-year term. May I now call for the motion?
I move that the appointed officers for a one-year term on the 2020-2021 Executive Committee be Adam Smith, Chair, Kelly McManus, Past Chair, Scott Gillifin, Treasurer, Glenn Thorpe, Vice Chair, Andrea Verbanek, Secretary.
I second the motion.
Any discussion? Great. There's no vote on this one. So the motion is the Executive Committee is appointed. I'd like to call for a motion to adjourn the board meeting.
I would move that all business having been conducted, the board meeting is adjourned.
Do we have a second?
Second that. I would second that motion.
Very good. Any questions? There's no vote on that one, I take it. I'm pleased to announce that the following individuals form the 2020-2021 Executive Committee for the Greater Kitchener-Waterloo Chamber of Commerce. Adam Smith, Chair, Kelly McManus, Past Chair, Scott Gilfillan, Treasurer, Glenn Thorpe, Vice Chair, and Andrea Verbanek, Secretary. Is there any further business? Hearing none, I call for a motion to adjourn the annual general meeting.
Unmute. I would move that all business having been conducted, the annual general meeting is adjourned.
I second the motion.
I'm pleased now to introduce the 2020-2021 Chair of the Greater Kitchener-Waterloo Chamber of Commerce, my colleague, Adam Smith.
Unmute, important thing to do. Thank you, Kelly. Your leadership on the board has been instrumental, especially in such uncertain times. I'm honored to be following in your steps and thankful for your ongoing support. And I'm eager to continue working closely with every member of our board. I would like to take a quick moment now to thank our sponsors for today's event. Our event sponsors, Cowan Insurance Group, Ernst & Young, Home Hardware, MCAP, University of Waterloo, and Wilfrid Laurier University, and our speaker sponsor, TD. Thank you for your continued support. We are also excited to announce that we are now accepting nominations for the 2021 Business Excellence Awards Gala that will be held on Thursday, February 18th. The evening, of course, will look a little bit different this year, but now more than ever, it's important to recognize the incredible accomplishments of businesses right here in our region. To nominate a local business, please visit greaterkwchamber.com. Nominations will be accepted until Friday, October 30th. I now have the pleasure of introducing today's speaker, Derek Burleton, who is Vice President and Deputy Chief Economist for TD Bank Group. In his role, he leads a team of economists that provides leading analysis on the Canadian and US economies. Derek maintains a strong interest in public policy issues and has written substantive reports on healthcare, sustainability, education, and immigration reform. He participates in a number of advisory and steering committees, both internal and external, to TD, and currently serves on the board of the Toronto Association of Business Economists. Derek has more than 20 years of experience as an economist in the financial industry, and today we are fortunate to have him join us to discuss the economic and financial position due to COVID-19. Derek will be answering a few questions following the presentation, which you can submit through the chat feature. Please welcome Derek Burleton.
Well, good morning, everybody. I just had a message flash across my screen saying my internet connection's unstable, so hopefully that doesn't bode ill. Hopefully you can hear me well. I have to say that the meeting has just gone by so smoothly. If all the meetings I've attended would go half as well, we'd be doing great. But anyway, it's delighted to be here on behalf of TD Bank. The timing is good. We just completed our latest quarterly global economic outlook. That went on the website last week. and obviously a ton of things to talk about. I will give you a bit of the lay of the land. We'll leave some time for questions at the end. Just a bit of context setting before I kick off with a bit of the global picture. The outlook has actually improved for 2020 relative to the way we saw things 3 months ago. I've been heartened at some of the recovery data we've seen. Hard to believe that the contractions we saw happened in about a 3-month span. I can't use the word unprecedented, so I won't, Kelly. But all I can tell you is that is the shortest recession I think we've had, but by far the deepest in history. Unusual that we'd have large swaths of the economy closed, you know, around the world all at the same time. But since the April data have come out, we've seen more of a V-shaped bounce back than we had expected in June. So heartened at that. We've seen employment roll back. Ontario's been a little bit slower to come back. Keep in mind that the easing of restrictions took a little bit longer in Ontario, a bit more of a cautious mindset there, but as reopening has happened, we've seen the data come back with punch. Now as we're entering the fall, change of seasons, my sense is we're entering a new phase, more of a challenging phase of the recovery. You know, I think we've gone from rebound to recuperation, and it's going to be a tough slog. I think we're all watching the COVID numbers, not only in Ontario, in parts of Europe, around the world. They have been coming back. They've been upticking, a second wave, and it's worrisome. At the same time, you know, you're getting a transitioning away from some of the emergency support. You're not getting the same fiscal impulse as you had a few months ago, and ditto for monetary impulse. So all signs point to a bit of a challenging end to the year. In terms of the, I'm just going to see if I can get my my slideshow moving here. There we go. Let me just flip back. Sorry about that. No, so I think I'm comfortable with the view for next year. You can see the bars heading down are these just enormous contractions that really were built in about a 3-month span. We are now in growth mode, but it's going to leave us down quite a bit for 2020. Canada is in the middle of the pack of the advanced economies in terms of contraction this year. Not as bad as Europe, worse than the United States. I think that reflects the fact that the economy was more closed during the early spring in Canada. We will see some of that momentum come back as we move through the end of this year into 2021. But growth should return across the board on an annual average next year. What we're debating about, certainly in our last forecast round, how quick will the rebound be next year? And I think if anything, even though we've had a lesser contraction this year, just given some of the V-shaped bounce we've seen of late, we're quite cautious on next year. And I think if anything, there's probably a downside risk on some of the rebounds. I think probably a more apt chart rather than show you growth, because the swings are just enormous, is looking at levels of activity. And I think this really tells the story. I know you hear a lot about the shape of recovery. Is it going to be a V? Is it going to be a U? Is it a Nike swoosh? We've certainly been on the Nike swoosh characterization at TD. But I think if anything, and I know some of you probably went to the University of Waterloo, which is great for math, it's probably more of a square root sign. I think it's after the V shape, it's going to kind of flatten out. I know it doesn't portray it as much in some of the quarterly data, but that's kind of the shape that's emerging. It's going to be an uneven recovery from here, but a relatively flat trend. And we don't expect to get back to any kind of pre-virus levels until the very end of next year, if not early 2022. So yeah, the U shape still applies, but I think if anything, probably looking a bit more like a square root, just given that strong bounce back that we've had in the May to June data, which incidentally is flattening out as we head into the fall. COVID is very much going to determine the shape of recovery. You know, our assumption that we build in our forecast is simply that, yes, a second wave, but it's going to result in more targeted, you know, restrictions. You know, I think of late that the trends have been on the mask wearing, the limiting of the social gatherings, not going to be widespread lockdowns. That is the risk. And I know we heard from Theresa Tam yesterday, the Canadian Public Health officer, that is worried. She's worried that if we don't really pay attention to the regulations, the social gatherings, then the numbers could get quite bad for COVID as we go through the fall in Canada. Again, Canada is not alone. If anything, we're seeing very similar trends around the world. Now, one thing I would point out, a couple of things, so that's our assumption that second wave it'll get worse, it'll die off. And the hope is by the second half of next year, we have a vaccine in place. And for many industries that are so troubled within the service side, just won't recover until a vaccine. We do build in a bit of a growth pop in the second half of next year to account for more of a recovery there. But overall, I think that it's going to be tough slog in the near term. The one thing I can say is that countries around the world that have seen sort of the earlier flu season, they're ahead of us. Flu is being, in a sense, crowded out by COVID. So, we worry about hospitalization rates. We worry about that. But I think there's a bit of an offset there that hopefully the flu season won't amount to as bad as we kind of work through probably some uptick in hospitalizations from COVID as a leading indicator. But I think the chart here I'm just trying to show you is that, things are getting worse. In Canada, we would see the numbers creep up. The US has been very challenged on the right-hand side of the chart. You can see the numbers there are beginning to ease, but of late, we've actually even seen the improvement there beginning to flatten out. Whereas in Europe, the UK, we're not that far away from more widespread tightening and restrictions there, maybe even more deeper lockdowns. The UK situation is much worse than Canada. So this is the big risk. What can I say? And all I can say is that I'm heartened by some of the developments on the vaccine front. There's yet another, I think J&J is the latest to enter stage 3 trials. And I'm comfortable with the view that by the second half of next year, we will have a vaccine in place. And from what I'm hearing in Ontario, it may even be mandatory to take it. That's some of the rumblings of late. So there's a bit of discussion around what share of the population will take it. Now, the data is flattening out, as mentioned, sort of that square root. You can see whether you look at global data in the US and Canada, it's a very similar trend. The easy part of the rebound is behind us. Of late now, we're in more of a grind, and it shows up in most data sets. Some industries in Canada, the United States, housing is still V-shaped. That's been a huge story. That's providing some offsetting economic benefits as people relocate from small condos to more space, to tight supplies, driving activity, home building. But for most sectors, you are getting a flattening out, as the data implies. This shows you restaurant reservations, which I guess I've been surprised at the uptick of late, but I would imagine those will flatten out as we get some of the data coming in, and flights as well. But again, that just reinforces the story. Now, today is, by the way, Speech from the Throne Day in Canada, and where all our eyes are going to be finely tuned to the TV or the internet or what have you, to get the latest on government priorities. The fiscal story, it's really been a 1-2 punch of policy supports to try and get the rebound and the recovery in motion. And I think for the most part, it seems to have paid dividends. I know we all worry a little bit about the fiscal hangover it's going to leave us with. But Canada is not alone, by the way. Again, all countries have seen enormous fiscal measures. In fact, Canada, you can see, is in the middle of the chart. I know that just the price tags of the wage subsidy, the price tag of the CERB emergency benefit are massive. And it just amazes me that a $5 billion program now can seem like nothing in light of what the massive expensive programs that have been designed to kind of bridge households and businesses over to the other side as we get recovery. And certainly the trend has been in Canada to extend, to gradually soften some of the cliff because the labor market is going to take some time to get back. And again, we'll get more on that later today. I think in terms of priorities, it's kind of well known where the federal government is going in Canada, that, that 3-pronged plan really focusing on the pandemic to start, ensuring the supports are in place, and even looking at some of the longer term challenges. Permanent fixes to EI and the like are probably going to form part of it. This is all going to be high level. As we know, we're going to have to wait a budget later in the fall. And I don't think the government's going to fall, the minority government's going to fall based on the speech, but there is still the question of whether we do have an election after the budget later this fall. But all that to say that, if anything, deficit projections are going to get even deeper. And I think it's going to be a challenge for whichever government's in place in 3, 4, 5 years' time to address some of the debt going forward. But Canada's still AAA, by the way, by 2 of the 3 major rating agencies. So again, I think the competitive story is important, that Canada is not alone. And in fact, the uptick in the debt and the like is less than we're seeing in the US and the like. The US, I think, would be the other one I would point out, is that, we do not have a replacement stimulus package in place yet. The end of the CARES stimulus is waning, and we know some of the impulse is declining as the extended unemployment insurance benefits are pared back, and they may go to zero. So that's a real risk to the forecast. We in our forecast have assumed a modest replacement package gets put in place, but I have to say now, as we head into the election, I know a lot of the focus has been on the replacing the Supreme Court and a lot of the distraction there, replacing that seat on the Supreme Court. The election is going to happen in early November, and your guess is as good as mine what happens there. I know Biden seems to have an edge, but a lot of issues, and I think just uncertainties there could lead to some financial market effect. But I am concerned about the fact that stimulus in the US is going to wane without any replacement package, and it's something that could, as I say, lead to more headwinds as we move into the fall. More on that in a second. I'm just going to skip ahead. I think all we show here is that based on the fiscal impulse, it wanes next year. Some of the emergency supports decline both around the advanced world and in Canada and the US. But it's going to be a bit of transition. I think, again, our assumption is that governments do step up with some transitionary support, which is going to lead to even higher deficits and debt down the road. On the monetary front, we're in a bit of a, much like on the fiscal side, we're in a bit of the middle in terms of impulse, because remember at the outset of the crisis, rates were cut, balance sheets were expanded, central banks did a lot to kind of add stimulus and cash to the system. It did relieve pressures and financial markets responded. But right now, central banks are kind of in a holding pattern, much like governments are transitioning away from stimulus. So this is where the risks come in financial markets as we end the year. We don't build any heroic assumption saying we're going to see a 15, 20% drop in stock markets, just given the fact that the grind is going to get a little bit choppy, but we could see that. And along with the lack of a U.S. fiscal package, it could be a significant downside risk. I think Kelly mentioned uncertainty. These are other areas of uncertainty that we have to face. Our assumption is that central banks in turn would respond with more asset purchases as they had and more balance sheet expansion if financial markets do get choppy. So we'll be looking for that. But as of right now, I think they're in a wait and see pattern in terms of supporting the system. There's not a lot further for rates to go down. And we know the Fed and the Bank of Canada do not want to cut rates in a negative territory. So if they do respond, it's going to be through changing forward guidance, just ensuring the markets that rates will remain near zero effectively for the foreseeable future, and then more asset purchases to add cash to the system. That's pretty much more of the same. And one wonders if that impact would diminish, and that's a risk. Financial conditions are strong to end the year. I know we read about the day-to-day wobbles in tech stocks, but overall measures of financial conditions. And on the left-hand side of that chart, a lower plot is good. It means that there's not a lot of financial stress in the system. It's only when that really surges, you worry about widening credit spreads for businesses. You worry about clogged up interbank funding markets. And right now, things are strong, favorable heading into the fall. You can see, though, that there's a little bit of an upswing there. And, I do worry, as I say, that maybe we're poised for an upcycle, much like we're in a second wave of COVID. Again, we only build in a modest reversal into our forecast. So that recovery view is sort of based on the notion that financial conditions remain quite favorable just to generate the the ongoing recovery. One of the stories in markets has been the US dollar. This is a favorable trend. The US dollar had been so strong early in the crisis against all currencies. Since April, as markets started to feel a bit better, the governments were responding with stimulus, central banks were, the US dollar weakened off quite a bit. And you can see the pullback in late March. That's a strengthening of the dollar. And since March the 22nd in the chart here, you've seen the US dollar weaken off. And that's been supportive for the global recovery. It's helped emerging markets that borrow a lot in US dollars. It's helped just general trade in the world. And we've seen trade activity, export and imports, that's been part of the V-shaped rebound across the goods area. Trade is beginning to thaw. I know there's still supply side challenges, but the weakening in the US dollar has been good to kind of kickstart the broader global economy. You're getting to a point, though, where currencies are a little toppish, like the euro, and central banks are trying to weaken it. Our view on the US dollar is probably it's gone too far and that you'd expect a bit of strengthening. That's assuming that global financial market conditions remain favorable. And then longer term, we see the US dollar is still being overvalued, and you'd see a weakening off. The Canadian dollar, I think I've got in the next chart, should strengthen on a trend basis, but only modestly. Keep in mind that Canada, ending the year, the economic recovery is better than we're seeing in the US, and that should provide some near-term support. But I'd say over next year, still some things that markets worry about: a big trade deficit, current account deficit. Things aren't normal in terms of trade yet, even with some of the recovery we've seen, and that's going to limit the upside. But you can see we do build in a modest upside back to kind of high 70s as we move through the end of this year. So again, I would say in the very near term, the risk would be a Canadian dollar to lose some ground as the US dollar strengthens. Going out beyond the next couple of months, we see the Canadian dollar strengthening a bit as the US dollar weakens. Yeah, I think one thing businesses can be assured of is that interest rates and yields aren't going anywhere anytime soon. Very modest uptick in yields builds in with that grind in the recovery that I talk about. Central banks pretty much remaining at zero in terms of their short-term rates for probably another 3 years or so. It's still very unusual, reflects slow recovery and the way I see downside risk on inflation in the very near term. So a little bit of a hockey stick up, but still low, and that bar just continues to sink as we move from forecast round to forecast round. Again, I'd say the latest twist in this whole saga is central banks getting more open to inflation. The US Fed, even the Bank of Canada, some of the signaling, they wouldn't mind seeing inflation rise above their target for a little while. And that just means that they're going to keep their short-term rate pegged at zero. And whereas 3 months ago, we would have thought 2022, that's now 2024, till we see any change in terms of short-term rates. Yeah, so I just to kind of summarize where we are in Canada, I would say that Canada has the growth momentum heading through the second half. The chart on the left shows you first half performance versus second half performance on both sides of the border. The US contracted a little less, but is seeing less upside. So when we've seen a flattening activity, it's been more prevalent in the US in recent high frequency data. A job market that's flattened out, more in the US than in Canada. And but I don't think Canada's immune to this. So, but heartened that we are seeing a bit of. So Canada does have a bit of the advantage heading through this year. And again, some of the uncertainties I've kind of talked about, maybe a bit of a downside risk on both of those second half performances, depending on the path of COVID. So, it's interesting. We put out the report the other day. The household is obviously very key in this whole equation, and some wonders about how the household has been faring. Job markets have rebounded. We've now recouped in Canada about 2/3 of the lost jobs through the March and April period. So more of a V-shaped recovery in employment. The US is down around 50%. So Canada's actually seen a bit of a relative improvement. Hours worked are still down and are recovering as well. I think they're about at 75% of pre-virus levels. as well. So that's helped the household of late, but one can't understate the importance of government supports. Again, the expensive programs have been put in place to cushion the blow of the CERB, which is now transitioning to an expanded EI and the CRB program, that's dedicated to some of the gig workers that were traditionally outside EI are being captured, but still the benefits are going to shrink. But, if you had told me that the unemployment rate would surge to double-digit levels, that we'd still have income growth, personal household income growth, I wouldn't have believed you. But it just shows the power in the second quarter here. You can see how the dotted line shows growth in income. That's just the power of CERB. And I know businesses have been concerned that CERB has kind of prevented households from participating in the labor market as much as they would have otherwise in some of the lower wage industries. And probably that does hold true to some extent, although surveys suggest it's maybe less of a problem than suggested in the media. But all that to say that is going to begin to wane. And the question is, will the recovery in the labor market be strong enough to prevent some of the transitioning away? Because, when you look at these new support programs, they're still going to mean lesser benefits for about, I'd say, 2 in 3 workers that were collecting CERB now shifting to EI. The benefit floor is lower. It's about $400 a week relative to $500 a week in EI and the like. So it's going to be a bit of a pinch, but we're counting on an improvement in jobs to continue, albeit at a slower rate, to sort of offset it, keep household income in positive territory. So that's one challenge and one risk and one question mark. The other thing is the end of mortgage deferral programs, lending deferrals by the banks. The fall is a busy time for that. I think the banks, just reading even the public commentary around it, they feel that most households are going to be fine, despite the fact they're going to have to start making mortgage payments again. Some of the worries on delinquencies are maybe 1%. It might lead to kind of a 1% increase in delinquency. So fairly modest. I mean, obviously still significant, but that most households are already, the ones that have seen their forbearance expire are making regular payments again. So we'll see. Obviously still some questions around that. And you will get banks, they've certainly suggested that there be, maybe more on a case-by-case basis, providing extensions to those households that require it and, are viable, I guess, much like businesses. So that's going to be a near-term challenge, the end of forbearance. But so you can see the cross currents as we move through. Early stage of rebound has gone quite well. And now you're getting more question marks as we kind of transition to the next phase of the recovery. But the unemployment rate, as you can see, should fall. Notice how high it remains, though, relative to pre-virus levels. And that just reflects, the square root sign recovery that I was speaking of. Now, labor market comparisons, this kind of hones in a little bit on what I was saying before. In terms of recovery, we've now seen in Canada 63.5% of the job losses having been recovered since April. In the US, it's about 50%, and hours worked, it's about 70%. I got that a little off. 68.9, 54 in the US. So recovery has been, again, better than I would have thought a few months ago. But now I think the challenging part begins. One wonders, participation rates have rebounded in the labor market. I know that the she session label often gets referred to, and I think that outside of Quebec, there is still a big gap between women part rates and male part rates, 25 to 54, quite a gap. So I think one of the themes in the speech today will be, how do we close that gap? Certainly child care investments, expanded investments there to help women participate more in the labor market. Because as we've seen the recovery in part rates, I think 2 things. It may lead to a sharper drop in the unemployment rate. And in a sense, we built some of that in why the unemployment rate falls, even though employment growth is quite moderate going forward. But if you can get higher rates, it may slow the unemployment. But I think overall, it's quite good. You want that supply of labor. And often the link is between supply and demand for labor. You get more supply, and that can lead to more demand. So, but these are obviously some of the key themes today in the speech from the throne. Early childhood development, investments in childcare. Just to follow through on that, I think the government seems to be dialing back some of its big and green initiative in the speech, and we'll see today. environment will feature into it, but maybe further down the speech than would have been the case, because pandemic has really gone central as we've seen the second wave. National Pharmacare is maybe not even get a mention in there, whereas before it was speculated to be another kind of longer term initiative they were going to be championing. So we've seen some shifts as the pandemic has got worse, and that will affect some of the big and green, albeit it'll still be an ambitious agenda. I think we'll see, maybe a little less so than would otherwise be the case. Now, I know within the Kitchener-Waterloo region, manufacturing is obviously a key driver of growth, as are the high tech. I think heartening that some of the recoveries in employment have been led by manufacturing, the high tech. We've seen these shifts in the economy, and some of the, what you'd expect to see, some of the laggards are high touch services to some extent, the accommodation and food. Financial insurance and real estate, we didn't see as big a drop in that, but it's been a bit of a holding pattern of late across those areas. But again, the drop was a lot less significant. A lot of the banks committed to not laying off any employees this year. So, maybe this is a little bit restorative in the sense it doesn't tell you how many jobs were lost, but this just shows you recovery rates from the April lows. But education, clearly as schools have re-begun, and we'll see what happens there. A lot of questions around schooling as we move through the year with COVID, but governments have been, stocking up, and we've seen a big recovery there as we've headed into the fall. Retail and wholesale trade, that to me has been the number one surprise. Again, speaks to the spending, V-shaped pattern in retail spending. Auto sales have been V-shaped. Home-related purchases have been V-shaped with the housing market. But, so a lot of that's been the goods demand. Services have been struggling on the household side, as we know. Tourism spending, a lot of that's been diverted, and that's helped the retail sector. And you kind of go down the list. That just on the right just shows you that male-female employment rate difference I was referring to, in part rate, that, is a gap, and certainly something that the government will hone in on today in the speech from the throne. Yeah, I think I've kind of covered this. The unemployment rates, both trending down very slowly. It's somewhat disappointing, and I don't want to go on about some of the challenges facing the economy's medium term, slower demographics relative to pre-COVID assumptions, albeit I would say that in Ontario and Canada, migration rates have held up better than we would have thought. So we really marked down our population growth as COVID hit, thinking the borders are effectively shut. It's going to rob universities of a lot of their international students. And we were very conservative. Migration numbers and permanent resident numbers have held up better. They're still well down from a year ago, but they've held up better. So Canada still does have the edge on demographics relative to the United States. But so it's a bit of a mixed story there. Not as bad as we thought, but still down. And something where, in terms of the housing market, I think I'm coming to that soon, will be somewhat of a drag. I know the numbers have just popped on prices and the like. But longer term, we would have a moderation in housing activity that partly reflected demographics. This just shows you the V-shaped bounce in spending. Consumer spending, we track a lot of real time data on this, whether it's our own internal transactions data on credit and debit. But the spending has now gone back up to positive year-over-year levels in both countries. The U.S. has been lagging a little bit of late, given its earlier second wave of COVID. But numbers have really come up, and again, that's been a surprise, I would say, quicker rebound than I would have thought. Yeah, that just builds in. You strip away some of the really weak high-touch industries, and it's been an even stronger rebound. Total spending relative, if you strip away the travel, recreation, transportation, it would be well up on a year-over-year basis. Housing has been up, not just in Ontario. I mean, the numbers have been off the charts. I think in Canada, average resale prices in the second quarter on an annual basis, so if you take the quarter-over-quarter change and assume it carries on for the full year, it's about 100%. And never have we seen such volatility in the data. It was a shutdown housing market, across Canada through March, and huge pent-up demand at a time that, a lot of households are still working. The biggest hit from the pandemic has been on the lower wage renter population, whereas, those higher wage jobs have been more resilient through the pandemic. in tech and the like. So just the fact that, the lower income has been hit harder. So you got to kind of take that into account, because I know people are surprised at the sales growth that we've seen, the rebound, but it's low rates, sub 2% mortgage rates. The fact that a lot of Ontarians and Canadians are still employed, and that pent-up demand from the shutdown market, all that contributes to just a phenomenon. And then, of course, pandemic impacts, people moving from, say, downtown Toronto, the small condos, to more space. Just that has created a wave in some of the single and the ground dwellings, semis. And so those shifts are certainly in Ontario. It's been sort of that earthquake, right? The tremor has been in downtown Toronto, and it's just cascaded to kind of Fort Erie in terms of that strength moving outside of the downtown core, because condos have not performed as well. Some of the high rises, as people have sought that extra space, getting out of the crowds. So I think all that to say that it's been a perfect storm for housing, and regardless of the high unemployment rate, but that it's unlikely to kind of keep going. I mean, we talk about unsustainable trends, and this is an unsustainable trend. I'm just going to flip to the vehicle sales, which have been, also V-shaped, and let's just give you a sense for, how the strength we've seen in the second half of this year will raise the levels for next year and the bounces we're going to see across the country. But I think just getting back to the prices, they're up, I think, 20% every year in the GTA region, extending out beyond the GTA into the Kitchener. And some of that is just compositional shift from lower priced condos to, higher priced single and semis. Some of that will calm down, but it's still going to be a market where it's going to be tight. I mean, supply's tight, but I think what we're just assuming is that, you get this, phenomenal rebound that just can't be sustained. You get more sort of a trend back to a more normal, but still a market that's hot. But again, the grind of the labor market will at some point bite a little bit more to housing demand. That and just the affordability equation, as prices get bid up for the semis and singles, some of the households that like to get into them just can't afford them. So I think all factors point to some cooling, along with a little bit of an uptick in mortgage rates. I'm just going to quickly, I think I missed a chart here. I think this may interest some of you. Just CapEx intentions on the business side. These are Canadian numbers, just showing you the outlook for this year. Manufacturing, you can see. I mean, most are in the red, as you can see. Accommodation and food. I don't think there are a lot of surprises here. CapEx is likely to be cut back in most areas, just given the uncertainty and the impact of COVID. Just some numbers on that front. I've just got a couple of charts, Dan, that I'd love to entertain some questions. You have kind of raced through a lot of this, covering a lot of topics in fairly succinct fashion. So, I think, and I know there's a message just being posted by Carolyn. If you've got any questions, feel free to kind of send them along. A couple of things. I think the vaccine is certainly something that, I think you'd probably be interested in some of the ongoing assumptions there. I kind of told you that we do build in a vaccine into the second half of our outlook. And it's, as the recovery grinds ahead in an uneven way, I think that's something that kind of the second half of 2021 can give an added impulse to what's going to be a more challenging first half of next year. As we deal with some of the ongoing pandemic related uncertainty from the election and all these risks. I mean, one could go down a laundry list. I mean, what happens if Biden takes over not only the presidency, but the full Congress? There's a blue wave, a lot of interesting shifts there. The market certainly wouldn't like that. And the tax and spending plans, certainly would be a concern to a lot of the US businesses. I don't know if you've seen, so it's a very, talk about ambitious, but something like a $4 trillion tax increase to fund $4 billion in spending as part of the Biden platform. Again, he needs Congress to kind of be on board, so you need kind of the blue wave, or else it would be watered down. But it gives you some of the uncertainties that US election on November 3rd is going to pose, alongside of, do we actually see a president? Do we have any kind of issues in terms of declaring a new president, with the mail-in votes and the lags there, and what will happen? So just that could be a real issue, and one could speak about that for quite some time. But the uncertainty, obviously, around the pandemic is front and center. The vaccine assumption is for the mid next year to be widely distributed. There could be an upside risk there. Maybe we see it happen more quickly, starting with focusing on those that need it the most. Canada's been busy at work trying to secure supplies. So I'm comfortable with that assumption, but I think the risks on that one go two ways in terms of its effectiveness. But I think for many of the industries that are struggling, whether it be tourism, you're going to need a vaccine to kind of get back to something more normal. This just shows you some of the impacts. It would drop the US unemployment rate, all things equal, and Canada as well. We show the US just because this chart was readily available. You can see the red line showing the assumption there. If we actually get a vaccine more quickly than the second, it will lead to a lower, a lower unemployment rate a little bit sooner. And then the presidency around Biden. These give you some of the aspects of his platform. And if you want more idea on it, we do have a report on our TD Economics website that kind of covers it. But he plans to really jack up tax rates on high income, the top 1%. And not only that, the general corporate tax rate would go up, I think, by 7 percentage points, if memory serves me correct, along with some other tax increases to fund about $4 trillion in spending. So that is, from a Canadian perspective, I think that cuts two ways. The extent that the money is not efficiently spent could lead to weaker U.S. competitiveness and challenges long term, which, for Canada makes us competitively better off, depending on the direction of our tax rates, I suppose. And certainly there's an upside risk in our tax rates longer term as well. Maybe, hopefully not as pronounced as that. But the other thing is that, weaker US can mean a weaker Canada through the trade channels. So just some issues to flag there. I think that kind of wraps it up in terms of some of the formal remarks. I think I would just summarize it again by saying, heartened at the starting point heading into the tail end of this year, the fourth quarter, more of a V-shaped bounce in activity across Canada, led by the manufacturing sector. That's been among the goods related sectors, other than construction, has been the strongest. But the grind, and I presented some of the headwinds. The grind's going to get tougher. Not only are the early returns of a rebound, the low-hanging fruit, easily picked, and now it gets tougher. But you add on COVID, you add on U.S. election uncertainty, you add on some of the risks to financial market conditions tightening, and we're in a kind of a gap in terms of stimulus right now. Not a lot of new stimulus, just kind of transitioning more gradually away from the original stimulus. So the question is, will the private sector take up the slack sufficiently to keep recovery going, at least at a moderate rate? And that's our underlying assumption in the forecast here. So that's it for me. I hope my connection was okay. I hope you caught a good chunk of what I said. It's been a pleasure, and I really thank you for inviting me to your AGM today to participate.
Well, thank you, Derek, and I do appreciate you taking time out of your schedules. It was very, very interesting. I'll keep an eye on the chat box and maybe keep flowing some of the questions. I guess one of the things that's coming up now, we've seen the rise in cases in Ontario and right across the country, and I think there's some fear. We are working here with the Cambridge Chamber, Waterloo Economic Development, and Communitech around what happens, how do we deal with it when it comes? Obviously, it's healthcare first, but I guess the question is, regional closures versus lockdown. I mean, we saw what happened when you locked down, the entire economy. Is that been factored in? Like when we have these waves, how the government and provincially, federally, and municipally will be addressing it, either through the regional approach or more of a blanket lockdown, and how will that affect the economy?
I think, Ian, that's the number one question I think right now. I think so to give you a sense, we go from this enormous rebound in the third quarter. We tend to use GDP. I mean, employment numbers are obviously phenomenal as well, but in Canada, about a 40 to 50% annualized rebound in GDP in the third quarter. But that still leaves us, I think that still leaves us a long way from where we were pre-virus. It's just the drop was so substantial in the second and even the first quarter. That kind of slows down to kind of a 3 or 4% rate in the fourth, and then grinds down even lower. And again, it comes down to the low-hanging fruit. It gets harder, and then you have these added headwinds and uncertainty I mentioned. So that's our prevailing assumption. I think on COVID, what's factored in there would be, the second wave numbers were of late. To give you a sense, I think in Ontario, we're back up to close to 450 to 500 per day in cases. The peak in April was about 600, just a tad over 600. So we're getting close to where we were at the peak. But I think, so that one might think, okay, that means that the chance of widespread lockdowns are dramatically rising as a result, because we're getting close to that. I think now governments feel they understand COVID quite a bit better than they did back in March and April. I think just the extent of the lockdowns is just a lack of not being ready. I mean, who was ready for a pandemic to start the year? And just the uncertainty around COVID. I think we've come a long way since then. The mask wearing, the health system is more prepared. We've seen a shift from the older population, being the main targets of COVID in terms of positive cases, to more of a younger population, the under 40s. Health outcomes with that tend to be lesser. I think I mentioned the flu season probably won't be as bad this year, just given the social distancing. The mask wearing is key. So I think the governments now are counting on that, and counting on, we'll hear from Trudeau today, he's going to be reading the Riot Act, that the young people that are getting together in big social gatherings, whether it be at university and the like, you gotta pay attention. Like, this is serious stuff. So hopefully that resonates. Our assumption in the forecast is you might have certainly a pause in some of the easing. We're not going to see a lot further easing from here, but not a huge negative rollback there. That if there is, it's going to be very targeted, and it's going to be more localized in both Canada and the United States. And that's so far the trends we've seen. And counting on, again, some of the other less intrusive things like mask wearing to hopefully get us through. And then the vaccine hopefully is coming up right behind us. So we'll see on that. That would be a huge step forward if we can get a vaccine distributed.
Yeah, and just thinking about the vaccine, as I mean, we've all seen, developing a vaccine is one thing, having widespread vaccinations is the other. So I mean, because that's really what's important. But is the vaccine development and the start of that vaccination, is confidence a big part of this? Like, I mean, when we look at, and I saw your graph on travel, hospitality, tourism, air, hotel, or that whole sector. How do we support that in the absence of a vaccine? Because people just are not using those services. And as part of getting that back up and running, supporting them now, but is vaccines really going to be the only way to really get those sectors of the economy up and running again?
Yeah, that would be a huge step forward, and I think that would really help confidence. And so that's one point. I think in terms of recovery, one would hope, again, COVID, it's been around now for what, I guess we're getting up to kind of 9 months. I guess, probably late last year, in China and Asia, but it's been roughly 8-9 months. And hopefully the virus, even without a vaccine, I know treatments are the other aspect that have really improved. It's not just about a vaccine. But I think we do understand, hopefully this thing would die, a death at some point. I know we talk about sort of the herd immunity, but whether, hopefully we don't have to go that route. So, but again, there's debate about what you need for herd immunity. Is it 60% of the population acquiring it? Is it 40%? So there's still a lot of debate there. But yeah, I think vaccines probably the quickest way there. And, I think in terms of restoring confidence, keep in mind after 9/11, everybody was saying nobody would ever travel again. And it was amazing how quickly people got back on planes after the horrors of 9/11. So I know right now, part of it is just simply the quarantining. People don't want to travel, but I wouldn't underestimate, a year from now. I know we're cautious in our forecast, more people traveling. There's got to be some pent-up demand there that we even expect in our forecast. I think we're trying to do our best to kind of manage upside and downside risks. But you could see, particularly if we get a vaccine by mid-next year, some of those sectors really pop back, and it could lead to, say, a better 2022. And, I know a lot of worries about the deficit, the fiscal challenges. If we can get growth better than expected, it's amazing what kind of dent that can put in the deficits, both Ontario and federally. So I just throw in that point as well.
Okay, as a not-for-profit, although a business not-for-profit, but many of our members, the Food Bank, I know Wendy and others, but there's all our community organizations as not-for-profits are really, it's a challenging time. Have you done any thinking around that sector? Because it's an incredibly important one for community development and support of the broader community, not just business. What's your sense of how they're going to fare over the course of the next year? Because it's been a challenging first 9 months, but what's the next 12 to 18 months bring?
Yeah, it's really been challenging. I think that I know knowing and dealing with a lot of different charities, I've been hearing the same message, and I mean they are becoming a more vital aspect of the recovery from pandemic and just recovery more generally. So hopefully we do see as we recover, most sectors will hopefully improve, and hopefully the not-for-profit will be part of that as we can get back to more of a normal pace. We need them more than ever right now. The challenging thing is with some of the economic impacts. It's affected all sectors, including not-for-profit. But I can't underestimate or can't understate how important they are as part of the equation. We actually don't have a forecast per se for the not-for-profit, but it's an area that is near and dear to us, and it's something I would like to write about. It's a topic that I think we've just been so busy at TD Economics trying to understand the pandemic, its impact on the labor market. Some of these other themes, we'd like to jump on. And I think the not-for-profit is a topic I'd like to wade into as things hopefully settle down a bit in terms of some of these other responsibilities and planning that we've been involved with at TD Economics. So.
One of the things that's really important, and I think we saw a little bit of this in your presentation, but immigration and newcomers to our community is incredibly important, just to get the right mix of folks for the jobs that are coming here in the future. We know and speak about this that all net new employment is going to be from immigration, within 5 years, give or take, and we're probably getting close to that here already. With the number of newcomers that we need to come here for the jobs that are available. So even in the context of jobs have gone down in this short term, what's the I guess the importance of the outlook for immigration as a driver of economic growth and the growth for the Canadian economy and the importance of immigration?
Yeah, it's huge, Ian, and it's something that we still are optimistic about. I know the pandemic really, we were at, I think, generational highs in terms of population growth, which, given some of the demographic headwinds, might astound many people. And it was because of, newcomers, both permanent and temporary newcomers, international students, and that really hit a skid with the pandemic. And, I think our forecast going forward, we do see a V-shaped rebound in that. I think once we get back to normal, once the borders reopen more fulsomely, hopefully by, next year sometime, we will start to see the flow again. I did mention I've been surprised at the resilience there, that we haven't seen the number of permanent residents dry up as much as we would have thought. It's been quite a bit weaker, not as weak as we would have expected. The federal government, and we'll hear probably more from that today at the speech from the throne, will be underscoring the importance. They'll be maintaining ambitious targets for new migrants and the like. So I think our longer term view, at least for now, is that it's going to still remain a competitive advantage for Canada. I still think that we are, when people look around the world and where to relocate, certainly Canada is viewed favorably, and a lot of the challenges south of the border and the like will continue to reflect a lot of talent our way. And that's something we still preserve in our medium-term outlook. We do, by the way, have Canada growing a little bit stronger than the US on a longer-term basis, partly reflecting the supply side, the immigration outlook, the labor market side. Productivity remains a shortfall there. The US has an edge on us, but net, Canada might have a slight edge. And hopefully that's an area. It'd be very interesting. I think we talk about all the headwinds from the pandemic. I'll be interested to see how the productivity numbers shape up going forward, because with such a shift towards digitization, a lot of the trends that were kind of more creeping trends heading into the pandemic have been accelerated. Kind of the shift to technologies and the like, becoming more efficient. This kind of venue, the Zoom, WebEx type thing, you know, a lot of things one would think should pay off longer term in terms of efficiency. Now we need to get the overall investment numbers up, which till we get over the hump on uncertainty may lag a bit. But I'll be curious to see if we do see any kind of productivity enhancements from some of the automation trends that I think have been accelerated.
Well, I want to thank. I'm getting lots of questions in on the group chat, or the chat box. So I'm trying to incorporate these. One that I think is folks are talking about is government debt, right? I mean, we've a huge amount of whatever you call it, stimulus or emergency support, and it leads to the question at some point: is our taxes going to have to go up? And I think some of the questions that have come in and I think this is where it gets, you have to, the big picture with the what I would say the more grassroots is tax season's coming up. People that have either their staff or themselves had to use CERB. What are the tax implications for that sort of thing? And then again, we talked about mortgage rates. I mean, those things are practical for households, right? I think you indicated those would stay fairly low, but when you try and put together that massive debt, the government debt, what is that going to do to tax rates? And so how will some of these programs, because I think people took programs, were not necessarily knowing what the impact's going to be at the end of the tax year.
Yeah, just on that point about Serbia, I think there's probably not a huge amount of awareness about some of the tax implications that, you know, I don't know what share, but many Canadians may have to pay taxes on some of the CERB payments, particularly if they regain employment quickly. So, I mean, part of, I think, the federal fiscal outlook and the Ontario outlook would build in quite a significant rebound in revenues, just partly because of, you know, that kind of dynamic, as well as just improving job market, improving incomes or growing income, and just the end of a lot of these temporary supports, or at least a phasing down. So yeah, I just on taxes, I think even with that, deficit may come down. Like this year, I think federally we're looking at a deficit in the order of, you know, 15 to 20% of GDP. I mean, just an astounding number. You haven't seen anything like it even close since the Great Depression back in the 30s and the like. So it's a huge deficit. Even if you see half of it come out of the equation, leaves a very structurally high deficit that will have to get addressed. And I do see the risk of taxes having to go up. I know they're already at relatively high levels on many fronts in Canada, particularly income taxes. I mean, we tend to be more of an income tax jurisdiction than we do, say, a sales tax, a value-added tax. And I do see, you know, whether we see a change in that mix, you know, I think what would be nice to see is some task force being struck to look at the tax system ahead of any kind of significant tax increase. So at least we levy the taxes on the less punitive economically. I don't see the risk of taxes going up this year. I think we'll get a budget out. And I don't think tax hikes will be included this time around, but the risk is 2021 and beyond, depending on where we are once the dust settles with some of these programs. And that's going to put pressure on finances. Certainly the focus would be on, much like the Biden, would be on higher income higher income earners rather, and corporations would probably see the bulk of it. But that's a risk. Just on mortgage rates, yeah, I mean, the rates now are at unprecedented levels. You know, we do see probably we're at a low, you know, unless the economy really flounders. And I don't rule out negative rates in Canada. And, you know, we've seen even negative rates on mortgages in places like Denmark and the like. They are lower. I think our 5-year rates are now down to about 1 3/4 in that zone. So very low. So there's still a gap there before they go negative. But yeah, I think barring a real slide in the economy going forward, like a W-shaped recovery, a double-dip recession, I'd say we think we're at our lows for rates, and they'll grind higher next year. I think we may see, you know, maybe a 0.5 point increase over the next 12 months on the 5-year. It still will be at 2 1/4. Still will be quite attractive, but it is a fact that will take some of the it'll weaken some of the affordability and economics of home buying at the margin, and part of the story for a bit of a normalization activity.
Well, I'm glad to hear I know the Canadian Chamber and our chamber network have been calling for a review of the tax system for a long time. It's been over 50, 60 years since it's been addressed. And if ever there was a time to do that, sort of echo your comments, that's something that would make a lot of sense. Now, we're almost out of time. I got two more questions for you. One relates to agriculture. And obviously agriculture here in Waterloo region is actually, if you include it with food processing, and prime agriculture is our #1 employer here in the region of Waterloo, in this part of southwestern Ontario. So hugely important to us. We've seen some of the recovery or some challenges with that. Is that around temporary workers? What are some of the challenges? Is that trade related? Is it COVID? Because it's a hugely important job creator here, but also creator of wealth here in Waterloo region.
Yeah, I think the reasons you mentioned are at play. You know, temporary workers, the shortages of labor. You know, so I think these factors have certainly been, you know, impeding some of the recovery there. You know what, that's something I was just speaking to a colleague yesterday. We're going to jump into a report immediately on the ag sector. We should have it out within 2 weeks. It'll be up on our site. We tend to like to do something in the autumn on agriculture. It's a fairly detailed outlook on the crop, the livestock industry, some of the cost related issues, you know, the Canadian dollar. We kind of fold it all in. You know, I think I don't want to do that report a disservice because it's not a sector that I've been following as closely of late, just given everything going on globally and trying to keep track of things. But, you know, much like I'd love to do something on the not-for-profit, this for sure is coming down the pipe over the next few weeks. So please look for that report. It'll be our annual report on agriculture.
Good. Now, last question, and it's not by no means least because it's and it revolves around China and the relationship with Canada, and that's got its own challenges because of political issues and security around 5G, and a number of things are all coming together. But China is such a huge, you know, generator of issues around the global economy, and obviously Canada's impacted by that. Where do you see that going? Because we're sort of pulled along with the American-China relationship. What are the challenges around the Canada-China economic relationship?
Yeah, I think we just recently heard from Trudeau. I think there were really the trend around the world, though. You know, as you know, since the Trump election, hard to believe it's been 4 years already. It seems like a decade. But, you know, just given, you know, we've kind of shifted away. And I think one of the impacts of the pandemic will be more anti-globalization in the very near term, you know, as economies still have a ways to recover and the like. So that's a trend that I think, if anything, you know, may get, you know, sort of an added fillip there. So, yeah, I don't see a lot. I think, I don't think, you know, we are in the direct, you know, in the direct target of China. I think they've got a lot of other challenges, particularly the US right now. And I think, you know, we'll wait and see what happens with the US election. The direct crosshairs was the expression I was looking for. But yeah, I think at the same time, it's going to be kind of a bit of a status quo. You know, we're looking at little irritances. We've seen China, you know, close some of their borders to some of Canadian exports in ag and the like. And those probably will remain irritances. But in terms of, you know, any kind of broad shifts in the trade dynamic, I think we'll probably be looking for very much the status quo. It's not a great story, but not a weak story. China's economy will, by the way, will be one of the leaders in 2020. Within emerging markets, they're struggling. So many of them are struggling with COVID. India, Brazil, and other challenges. China is doing better. And I think it's going to provide benefits to a lot of their trading partners in the direct Asian area. And certainly you saw that chart at the start showing emerging markets rebound. China is the bulk of that. Mm-hmm. So we do think that China's going to do quite well. So at least you're going to get some demand for some of Canadian commodities. But I'd still think that the US-China relationship's the big risk that could hit Canada through second order effects.
Listen, we'll leave it there. I want to thank you, Derek, for taking time today. It's been a fascinating presentation. I appreciate you taking some questions from us. And to your colleagues, Kenda and John, who we work with on a daily basis here at the Chamber and locally, are great partners of ours and support a lot of the work that we do for businesses of all sizes. So thanks for your time today, and I'll pass it back over to Adam.
All right, yeah, thank you both. Thanks also to TD and Derek, and for your time and insights and for sharing that with us. So we'll now be opening up a couple smaller breakout rooms for networking. They'll be automatically assigned and you'll receive notifications momentarily. We thank you for attending today's annual general meeting and hope to see you at an upcoming virtual event very soon. Thanks.